from a young age, I just always knew I wanted to be a business owner, bro.
Right.
Before I even knew what that meant, it just felt like, hey, I should be doing something independent. I should be creating something of my own, being my own boss, being in control.
Right.
Welcome back to the Black Millionaires podcast, where we talk money, marketing, and motivation. We're your host. I'm Clift Roach II. This is CEO James Hill, and today we have a very special treat for you guys. We have the honor and the privilege of having one of Detroit's very own. This guy is a great role model. He's a great father. He's a great husband. He's also giving back to the community, running his own financial planning firm. He has a sharp background in finance, managed over $200 million in assets. I want you guys to join us in welcoming Ty Thorpe.
Wow. It's a good intro, man. Thanks for having me.
Ty, you taught me a lot. You know, we always, if I need some investment advice, if I'm looking at a stock, I run something by you. You help Cliff out. So now you're going to help our visitors and our listeners out. And but first, before we get to talking about any type of investment philosophy or anything, we want to talk about you as an individual, because I think it's very needed, and we need to see Black men and in our communities talk about finances, talk about wealth building, talk about being a staple in our community in terms of being a good role model, being a good father. So let's talk about Ty when he was going through the transition, getting out of college or getting out of high school, deciding what route he wanted to go down. Why did you pick finance?
Yeah, good question. So, my journey was different, right? It wasn't high school, college, boom, I'm here.
Right.
Right. I went to Martin Luther King High School, right? East Side all day.
East Side too. So I don't know what Cliff. I don't know where you at, brother.
No comment.
From
right,
the D.
right. Right out of high school, I went to Grand Valley. Majored in accounting. Dropped out after 3 semesters.
Okay.
Moved to Oklahoma for a year. Came back and just worked. Right? So I was just working a job, working in a warehouse. Then I went back to school and went to Wayne State.
Right.
And shifted my major to finance. Right. So that's when I started getting exposed to the sophistication of finance and how it works. The thing that always intrigued me about finance was just, how does money work? Right. Ever since I was a little boy, how does money work? How do companies do what they do? How do they operate? Where's all this money coming from?
Right.
So it was always just an interest in money that made me interested in finance. So, I switched my major at Wayne State to finance, finished, got a job at one of the largest investment banks in the world. And that's where I really start to learn the game, right? In school, you learn what you learn. But when you're actually in it, I started really learning the game and really learning how this money machine works. And I learned a lot there. I learned a ton of information, the wealth of information that I still utilize and apply to this day.
Right.
And always would be grateful for that opportunity. But, it was just always just an interest in money that initially just drove me to wanting to get into this world of finance.
Okay. Now, when you first got into finance, were you nervous because it's a predominantly white industry? Were you nervous about, hey, I'm going to be the only Black guy in the office? Or were you excited about that? Because I know when I was working in banking, I was one of the only Black guys around. And, when I was doing good, when my number got called, when, I was one of the top bankers, it actually made me feel good. And then when I saw other Black guys coming up to me saying, hey, I want to, I'm going to be on there just like you, it kind of motivated me, and it motivated me to recruit other people into the organization when I was working for, one of the top mortgage companies. So how did that make you feel being one of the only Black men and having that pressure? Because, sometimes when you do bad, it's like you represent the whole community. When you do good, they try to shield that away and just say, okay, you just one of them doing good. How did that make you feel?
Yeah, so first of all, I was excited initially. I'm happy, I'm excited. You got to understand, I came from blue collar,
right,
working in the warehouse,
right,
dramatic shift to now I'm wearing suits every
white
day.
collar, yeah,
right. Now I got on suits, right. I went from wearing
Boots.
Exactly. I went from boots to suits.
Ferragamo loafers.
Right. Literally, right? So I'm excited. Like
Right.
I'm wearing suits every day. I'm in the office, right? I'm in this whole different structure, this different world. And again, I'm with one of the top banks in the world. I'm excited. And then it just took a little bit of time for me to realize, like, wow, it ain't that many of us around here doing this.
Right.
Right? So then I start feeling that pressure, like, wow, I gotta be on point.
Right.
Right? I gotta, when I do my Series 7, I can't fail.
Right.
I get my Series 66, I can't fail. Because it's almost like they expect me to fail. Right? So, you got that added pressure. And, luckily, obviously, I was able to, knock out those exams and do what I had to do.
What is a series what is a Series 7 and a Series 66 for the people who probably don't know?
Yep. So
in the investment world.
To simplify as best as I can, it's a investment license, right? Gives me the ability to trade investments on behalf of a client and also receive compensation for that transaction.
Okay.
Right? Just to simplify it. So yeah, I had to get fully licensed. And once I got that taken care of. Then when it comes into the business part now, as far as building the clientele and doing what I have to do, that's a whole different type of pressure, because now it's like your counterparts are in front of money all day, every day.
Right.
I came from nothing.
Right.
I have to figure out how can I get in front of money when I have no outlet, no network, no nothing. I just got to figure it out. So, this business, it really tests you, right? You really have to have a lot of grit, and you just have to want it, for the most part. And again, being a black man, it isn't easy, right? It isn't easy. So it's about having a vision and just knowing, like, I have to do this. I'm going to make this happen, and nothing's going to stop me. So I don't let, my color, I don't let my circumstance, I don't let any of that get in the way. No matter how discouraged I may feel at one point, no matter how excited I feel at one point, whatever, it's just a matter of just making it happen.
What sticks out to me the most, man, about your story, and I love it, right? I heard you tell it before. Every time it resonates with me is that your route wasn't traditional, right? Like you said. And the university we went to, I know that the retention rate for black men was 4%.
Right.
Meaning if you came into that university as a black man, only 4%, 4 out of 100 of us graduated from that university.
That's crazy when you think about it.
Right? And here's the thing. This is what I love about your story, Ty. You dropped out of school, you went blue collar, and then you came back to school and went straight white collar, right? Professionalism, business owner. Most people, that other 96%, when they drop out, they may go blue collar and stay there.
Yeah,
they never
absolutely.
get out, right?
Absolutely.
That's what I love the most about your story is I didn't get stuck in the I have to work 40 hours a week and do hard labor, right? Our older generation, right? Our parents, they're probably just blue collar. If I'm not punching the clock 40 hours a week, working for a company doing blue collar labor, I'm not bringing home money and putting food on the table, right? But that wasn't the circumstance for you. You said, hey, I can make this pivot. I can go back, finish up this education, kind of in the same space, right? In the money space, from accounting to finance, very similar. Yeah. And then I'm able to flip that and get back on track and really not just be a blue collar worker or not drop out of school and try to be an artist or an athlete, et cetera, but I can still finish in this professional realm and be a business owner, even though I had some adversity along the way.
Yeah, man. And I think my story actually helped me get where I'm at.
Right.
Right? Because when I share that story, it just makes people say, man, I like this guy. Like he has what it takes, right? To be able to do that. Because you're right. A lot of people, if they leave school and go blue collar, they do get stuck there. So it goes back to, what is the vision that you have for your life, right? Are you going to put the work in, right? It isn't just going to happen. It isn't just going to fall out the sky and poof appear. Like, what's the vision? And, when I was working blue collar, when I had on the boots, I hated it.
Right.
I hated it to the point where, you know what? I'm going to do whatever it takes to make sure I don't retire here.
Right.
Right? That was it. So I went back to school. I'm working 6 days a week, 5 classes a semester.
Right.
Full time. I'm getting off of work at 6 o'clock in the morning. I'm at Wayne State at 8 o'clock in the morning. Don't leave campus till 1 o'clock in the afternoon. Go home, shower, take a nap, wake up, do some work, some school work, go back to work the graveyard shift. That was my life for 2 years straight.
Wow.
No sleep, 2 hours, 3 hours of sleep every single night, 2 years straight. But it all paid off. Graduated cum laude. So it was tough, but it wasn't tough, right? Because I had to do it.
Right.
Right. When you have to do something, you don't have time to worry about how difficult it is.
It
right?
wasn't an option
It's
to
not
go
even-
back to what you wanted. It wasn't an option.
It has to get done. So do it, and that's what I did. So, and I think my story got me here in front of you all right now.
Did you have anybody pushing you to go down that professional route, to go down that, hey, go back to school? Because a lot of times, like I remember when I went to college, my family didn't even believe I was going. So when I was at college, my second day there, they called me and said, where you at? I'm like, dude, I'm in college. Like, I told you I was going to school. And they like, no, so when you coming home? I'm like, I stay here now, right? So, and then it was one of those situations where I went through some adversity. I lost my apartment and a dorm and all of that in school, and I was faced with the decision to leave and go back to the hood and get a job, because I was working in a warehouse as well, which is crazy. And I decided to stay in school even though I didn't have a place to stay, but I knew this is the adversity, and I was forced with a decision to stay and get through it. And I didn't give myself an option to go back home. And that's what I like what you said. Like, I didn't give myself an option to stay at this job forever. I knew, you knew you wanted better for yourself. So was there any mentor or somebody pushing you towards, like, just going for that professional job or even starting a business? Was there anybody that told you can even do it?
Absolutely not. No mentor, no cheerleader, all the grace of God,
Right.
and the vision. That was it. That's all I had. I had to be the motivator. I had to be the starter. I had to be everything. I had to be my cheerleader. I had to be my alarm clock. I had to be my encourager. Right? Didn't have any of that. Right? So it comes from within. When you look at great athletes, they don't need nobody to cheer them.
Yeah.
Kobe ain't need nobody. It's all within.
Right.
Mike didn't need anybody. It's all within. So that was my story. That was my route. I didn't have mentors giving me game. I didn't have anybody that I could look up to. I didn't have anybody I can call. Everything. My mentors were books.
Right.
Right. I got digital mentors, I guess. Right. Robert Kiyosaki, Rich Dad Poor Dad. I read that when I was 19. Changed my life.
Right.
Right. Then you read Richest Man in Babylon.
That's my
Changed
favorite.
you know what I'm saying? Think and Grow Rich.
It's one of my favorites.
So those books were my mentors.
Right.
So I guess, in a sense, yeah, I did have mentors. It was these pages that I was reading every day, every night. Right. And just helping my mind evolve. Right. And just wanting, when you read those type of books, you naturally just want to do better.
Right.
There's no way you can read those books and still stay in the same mindset.
Yeah.
And stay complacent. There's just no way. Right. So, I'm reading those books, and I guess those were my mentors. But as far as an actual person, nada. Didn't have it. Still don't have it, really. I mean, I do, but, not really. It's still.
It's still you still need that internal drive, right?
It comes from within.
Yes, sir.
That's it.
I want to get into some finances, because you are a financial professional. You own your own firm. You manage over $200 million in assets. You have the experience working at major corporations and working for yourself. So let's get into some philosophies in terms of, let's even stay with something simple as insurance, right? A lot of people always debate about permanent insurance versus term insurance. Which one should you have? I always say you should just have insurance. Just make sure you have one of them, right? I don't care which one you pick.
Right.
At least have one of them. That's better than not having any. But from your perspective, explain the differences between the two, the benefits of each, and then we're gonna get into a little more about how and like what kind of company you want to deal with, because that's, I mean, a lot of people go online and just click, because I know we was having a conversation, and I was looking up some insurance, and Dave Ramsey said go to this website, right? So you go to a website and they give you a quote and you think that's enough,
Yeah.
but you really need to talk to a financial service professional and have somebody explain it. So just explain the differences between term and permanent.
Yep.
And yeah, go ahead.
Yeah.
Go ahead.
So when it comes to life insurance, it's a unique financial vehicle.
Right.
Right. So when we're talking term versus permanent, that truly matters. Right. So those are two, I call it categories.
Mm-hmm.
Right. You got the term category and the permanent category, and then you have just different types that fall under those categories.
Right.
So let's start with term. Term, probably most people have that.
Exactly.
Right. When you have insurance through your employer, it's likely a term policy that's offered through the employer.
Mm-hmm.
Once you leave that employer, it goes away. It doesn't
Right.
come with you. Sometimes you'll receive an email or a phone call from the actual insurance company that would try to then solicit some business. Like, hey, if you want to keep the insurance, you can. You just have to go through this underwriting process, right?
Right.
But term insurance, it's to put it in its simplest form, it's like renting. Right, a home,
Mm-hmm.
right. So it isn't permanent,
Right.
right. It has an expiration, right, and it can be a defined number of years, or it can be to a particular age,
Right.
right. And because of that, most people outlive their term policies,
Right.
right. If you check the stats, I think it's somewhere like term policies pay like 3 or 4% or something, like they pay out 3 or 4% of policies of term policies pay out.
Right.
And that's because most people outlive the policy.
Mm-hmm.
And because of that, life insurance companies don't see a huge risk, so they allow people to get a large death benefit for a relatively affordable cost.
Right.
Right. So term insurance, very pivotal, right? Everyone should, like, again, I agree. So everyone should have some type of insurance, have something.
Right.
Especially in the Black community, have something. But term insurance is, if you just need something quick and you need something affordable, that's
Mm-hmm.
usually the route to go. Now, when it comes to what's the proper amount,
Right.
there's different ways to run an assessment. Most people will just factor in all of their debt, right? I got a mortgage, I have loans, I have this, right? And they add that all out, add that up to come up with a number,
Right.
right? And they choose that. The route that my team and I use is we just have you max out the most that you qualify for,
Mm-hmm.
right? We're going to see, how old are you? What's your income? Okay, this is the most that you can get.
Yeah.
So we just start from the top and then we right size it from there.
I like that because when I first got my policy, I just got 10 times my income. That was my philosophy. You get 10 to 12 times your income.
Yeah.
And then I was earning $50,000 a year at that time. And then Clift, who is my financial advisor, said, so what you gonna do when you earn $100,000?
Exactly.
Because the $100,000, like you started this business, you earning 5 figures a month profit. Like, so if you just do a multiple on that, and we just say you earn that over 2 years, so now your income has tripled or doubled. So what you still gonna have 500,000. So I was thinking like, I'll just get it down the line, and now he changed my perspective on that. I should get the most that I can get right now because my income is going to grow, and I don't want to outgrow my policy and have $200,000 in insurance, but I'm making $200,000, so now it don't even make sense.
Exactly. And then you got to factor in the health,
Mm-hmm.
right? Okay, I got 500,000 now. I'm young. I'm good. Yeah, I know I can get 1.5, but I'm gonna just get 500,000. I'll
Right.
come back, and get the other million 2 years later. But what if something happens to your health within those 2 years?
COVID-19, right? How many
You know?
millions overnight?
Right.
COVID-19. Now, if you contracted COVID-19, life insurance companies aren't too eager to make you an offer now.
Right.
They're going to decline you,
Mm-hmm.
or they're going to tell you got to come back in a year or come back in 2 years, right?
Right.
So, that unpredictability of life, life doesn't move in a straight line. So, I always share with clients, especially when I speak to younger professionals, it's like, I know it doesn't make sense at this time for you to have this amount of coverage on your life. You're single.
Right.
You don't have any children. This makes no sense. I get that. But in my space where I operate, I'm always looking into the future.
Right.
Right. Yeah, we're in 2020, but I'm thinking about 2030.
Mm-hmm.
I'm thinking about 2040. I'm thinking about your life when you're 30, 40, 50, 60, 70.
Right.
You're going to go through all these life events. We want to be proactive. Let's just get ahead of it. Let's take care of these things now so that when you do go through those life events, you don't have to worry about it. It's already taken care of.
Right.
Right. So, that's our philosophy and our approach. Now, when it comes to permanent insurance,
right.
Now, permanent insurance, it has a lot of different types under that category.
Mm-hmm.
Right. You got universal, you have whole life, you have variable, you have index,
mm-hmm.
right? Universal. So you have all these different types. And, when we're having a discussion, when we're describing it, I'm going to just talk about permanent whole life, because
mm-hmm.
it's a lot of opinions
right.
about permanent whole life. And permanent whole life is probably one of the best kept secrets as far as integrating that into your overall portfolio. Right. So permanent whole life, what it does is as you're making these payments into the policy, you're actually building up equity within that policy. So if term is renting the home,
right.
Permanent whole life is now owning the home.
Right.
Same concept. You have a mortgage on the home. As you pay down that mortgage, the equity in your home increases. Same concept with the permanent whole life. As you make these payments, the cost of insurance is decreasing, and that is increasing the equity in the policy. So, you're growing this cash within that policy, and then it just becomes an asset, right, that you can access anytime you want to. There's no age restrictions. There's no penalties and fees and things like, well, I guess it depends on which company you go through.
Right. We're going to talk about that a little later.
Right. But it becomes an asset over time. And, my philosophy is everyone should have permanent coverage on their life, because permanent is what it is. It's permanent. It's going to be there when it's needed, right? One thing that's certain for sure is that we're all going to expire.
Right.
Right. And when we expire, we need to have that permanent insurance in place that can take care of any final expenses, funeral expenses, leaving a legacy, whatever the case may be. Term, unfortunately, because it expires, if you live to 90, you ain't going to have a term policy.
Right.
Right. So you have to have, so my philosophy is, having that permanent on the books is very necessary. But when we're talking about strategically designing it and using it and structuring it or fitting it into an overall portfolio, we can get really creative with it.
Yeah. I have a different philosophy on it. And I always, default to you guys because you guys are in the industry and you guys are on the ground working with families every day. So I have my policy and it's up to age 80. So my philosophy is by the time I'm 80, I'm going to have enough assets to where if I don't have that $1 million in coverage, or if I get another 1.5 million or whatever I'm going to have enough assets to pass on along to my family. And me and him debate about this all the time. He like, that's cute to talk about right now. But like at the end of the day, most people not even thinking about life insurance or assets accumulation at 25 or 26 like I am in general. Yeah. So I think it's debatable. It depends on your lifestyle. It depends on what you want in life. Most people don't want to start a business. Most people don't want to acquire assets. Most people just want to work at a job, live happily, and, they just want something to pass on to their family. So yeah. I think you have to evaluate your situation. And for one, like I said, I always tell people, have insurance. You can debate all you want about which one you want. It's not what insurance you're getting. It's you're getting insurance, and you're going to get whichever one makes sense for you at that moment. And sometimes it makes sense to get term. Sometimes it may make sense for you to get permanent, especially if somebody know they have some type of, or they might run into some type of issues down the line when they're not probably going to qualify for it. That probably, that's a different conversation. But yeah. So what's your thoughts on that one? Because I know we talk about that a lot.
So, like you said, I buy term insurance. I know it's going to expire, but all along I'm making investments elsewhere. But what we cannot leave out is anyone who has desires like you do to acquire a large amount of assets, you're going to run into a tax problem. It doesn't matter.
Right.
So you can either transfer your assets and leave a tax burden on your heirs, or you can transfer wealth and not leave a tax burden.
Mm-hmm.
Right? The most efficient and the only way to transfer that wealth without a tax burden is with the permanent life insurance, right? It doesn't matter about what you're building up, even if it's a company on the side, if it's assets in the market, whatever it is. One thing that's going to happen is you're going to leave a tax liability for the next generation who may or may not be equipped to handle that if that's the only inheritance they're going to receive. Now, granted, I'd rather receive assets from my father that are taxed than nothing at all.
Exactly.
Right. However, but if I don't have to leave a tax burden, why would I? And to kind of flip the script real quick, because I wanted to ask Ty a question, right? You talked about permanent and, hey, I don't outlive a death benefit, but you mentioned something about me building equity in the policy, right?
Yeah.
You kind of skipped over a little bit. Most people may understand, they may not understand what building equity means. Talk to us more about the cash buildup, right? Okay, you said cash builds up. You said I can have the policy pay out my family whenever I die, but what about this money inside of it? Like, how can I tap this, right? What do I use this for? How do I access it? What advantage do I have? Why would I build up cash in this when I can invest in a market and get a return?
Right.
Why would I build cash in this when I can keep money in my bank account? Talk about this equity and how we can leverage that while we're alive.
Yeah. So, the beautiful thing about, permanent whole life is, again, you are able to build up this equity. You're building up this cash. So the way that it works or can work, depending on which company you go through. Some companies pay a dividend into a policy, right? So you're making your payments, and every year you'll get a dividend. That dividend helps, purchase more death benefit, and then it also helps grow that cash value. And then you also can get assessed a credit, to your policy that helps that policy's cash grow even more. Now, what the cash is doing is it's growing in a safe environment, right? So these dollars are not invested in the stock market. So you're not going to see fluctuations in your balance when we're talking about this cash that's in this policy. It's just going to grow and continue to grow. Now, as far as accessing the cash, it's a number of different ways that can be done, right? You can do a straight withdrawal, right? You can take out your principal. So what you put in, you can take back out, right? Without having to worry about taxes because you paid after-tax dollars into it.
Right.
You can, if you tap into the interest, you can do a straight withdrawal of the interest. But when you do that, the IRS looks at that as income, and now you have to pay taxes on that interest. Or you can borrow or take a loan against the policy to tap into that interest. That way, you get around having to pay taxes, and instead, you pay an interest rate.
Mm-hmm.
And the interest rate is going to be far less than what your federal income tax rate is.
Right.
So a lot of people use that strategy. And then another strategy is collateralizing the policy, meaning taking the policy to the bank, putting it up as collateral, and opening up a business line of credit. Right. So that gets more that's a more sophisticated method. But nevertheless, a lot of policyholders do that too to get, just to take advantage of this asset. So, things that you can use this cash for, whatever you want to use it for.
Right.
You want to go buy a car and you got $60,000 in your policy, you can go get a car. Mm-hmm. Right? Instead of going to the bank and applying for financing, hey, I got $60,000. I'm gonna just take a loan against my policy, spend $15,000 on the car. And now instead of paying the bank back, right, in interest, paying the bank back with the interest, I'm paying myself back now. Mm-hmm. Right? So now I've essentially created my own bank. Right? If you can look this up on the internet, people call it like family banking, right, for example. Also, when we're talking about an overall portfolio, using it, I call it a hedge. Right? You hear me say this all the time, right? I love
It's
saying
his
it.
favorite term.
You know, using it as a hedge. So for someone that does believe, I'm gonna just invest my money because I can expose myself to more risk to get more reward.
Right.
Awesome, but you still want to have a hedge in place. You want to hedge your bet, right? So that when the market does go down, when the market does experience that volatility, right, and your investments is going down now, there's nothing you can do about market risk. You have no control over that,
Right.
right? So when that happens, that hedge, which can be, permanent life insurance. It can be, some people use gold as a hedge, right? It's not just limited to insurance, but that's what we're talking about now. So, if you got this policy in place and there's enough equity that's been built up, now when the market goes down, you can take some dollars out of that hedge, out of that, pull from that equity and take more positions in the market at the discount now. Right? So you can really, when I say it's a multi-purpose vehicle, it's truly a multi-purpose vehicle. There's so many different ways to use it. I can talk about it for 3 hours straight, but I'm not going to do that for the sake of brevity. But, it's a very unique vehicle. And, when we're talking about just utilizing it in all the different ways it can be utilized, man, it's a beautiful thing.
Yeah, I don't have permanent life insurance, and one of the reasons we were talking about it, and one thing you educated me on was the difference between a stockholder company, and a mutual company. So educate people on the differences between that, because that can change a lot. So when I did my research and I'm looking at a lot of these policies, I'm looking at a lot of companies that are stockholder companies, and I'm like, it's not a good idea. Like I'm just not buying into it, right? And then he told me about the differences between the two. So just educate people on the differences between a mutual company and a stockholder company and the benefits.
So, a stock company, companies we're pretty much all familiar with. These are the companies that are on the stock exchange. You can buy shares of this company, right? And they have a duty to satisfy the stockholders.
The shareholders, correct? Right.
The shareholders, stockholders, they have a duty to satisfy their shareholders, right? The investors first. They have a duty to make sure the numbers are solid when they're reporting to Wall Street. They have to satisfy Wall Street. They want to satisfy the shareholders. Why? Because when they satisfy these groups, it helps their share price increase.
Right.
And that helps the value of the company increase. Right? So they have a duty to the shareholders first.
Mm-hmm.
So if I have a life insurance contract with a stock company, I'm not first priority as a policyholder.
Right.
First priority is the shareholder and then the policyholder.
Right.
So the company is going to do, first and foremost, what's in the best interest to satisfy the shareholders.
Right.
And then I'm second as a policyholder.
Right.
If you like being second, cool. Go ahead and run with the stock company to have your policy through. Now with a mutual company, it's structured differently. So now the mutual company is actually owned by the policyholders now.
Right.
Right. So instead of you having shareholders, it's just the company and the policyholders.
Right.
So now the company is going to do whatever it takes to satisfy the policyholders.
Mm-hmm.
They're going to do whatever it takes to make sure the policyholders are taken care of. We're going to do whatever it takes to make sure the cash value in these policyholders' contracts is growing significantly.
Right.
So now you cut out that middleman, that shareholder middleman is gone. We're talking about a mutual company, right? So now you don't have that conflict of interest. I got to satisfy Wall Street. I got to satisfy this other entity over here. You don't have that conflict when you're dealing with the mutual company, right? So that plays a very significant role, and that's very important when you're looking at life insurance contracts, because at the end of the day, especially when it comes to permanent insurance, you want it to perform, right? Right. Even if you're strictly death benefit focused, like I don't need the cash, I only need it for the death benefit, you still want it to perform well. Right. So, and when it's with the mutual company, it's just going to perform better than that of a contract that's with a stock company.
Yeah, man. I mean, that's something that most people need to research. I definitely had to do my research on it. And just talking to you about it, we always talk about financial decisions before I make a decision or whatever. I always love to hear your philosophy on just making that decision on a mutual company versus a stock holding company, and even to partner with a mutual company versus a stock holding company. It makes a huge difference.
Absolutely. And I think he hit the nail on the head with the, do you want to be second place or do you want to be first priority, right?
Right.
So when it comes to, hey, I'm obtaining these contracts, and I want to see my equity grow, right? I want to leverage this for business opportunities down the line. I want to go with the team that is focused on giving me a growth in that space. I don't want to go with the team where they're focusing on satisfying everyone else first. And this is just on the technicality side of people who are looking to really leverage this tool down the line.
Right.
If we're talking about, I just want a company that's going to do good, that's going to pay out a claim when I need it to, now we're talking about financial strength rating, right?
Right.
We're not even so much hung up on do they pay dividends to the shareholders or me first?
Term versus permanent.
Right.
You're just trying to find
We're looking at reputation, right? So I want to pick your brain again on this, Ty. Talk about what should we be looking for in terms of what type of ratings do we want our companies to have? How do we determine if a life insurance company is going to back their promise, right? We talk about term. You said a large amount of coverage for very insignificant costs. If you're an 18-year-old male, you're in good health, $1 million in coverage could be $40, depending on the company. Okay, so how do I know they're going to pay out that $1 million, right? Because if I pay that $40 one time and they're talking about they're going to pay $1 million, well, how do I know I can trust this company, right? What am I looking for to make sure that they're going to follow through on their promises?
Absolutely. So financial strength of a company is very pivotal as well, right? So when you think of, let's take the personal credit score, for example, right? We know the highest credit score you can get is at 850.
Right.
Right? You come across somebody and say, I got an 850 credit score. You're like, woo, okay, you top notch. When it comes to companies, when we apply that same concept, they're graded in, AAA, AA, single A, triple B, right? So that's how they're graded. AAA is the highest rating that a company can receive from a financial strength position. And in America or in the world, there are only two companies right now currently. I'm not going to say the company's names, but you can go on Google and find that out. So when it comes to a life insurance company, you definitely want a company that has the financial strength that if I get the policy when I'm 20, I don't pass away until I'm 80. First and foremost, is this company still going to be around? Right. First and foremost, right? So that plays a significant role, and there's been a lot of companies that did go under, insurance companies that did go under, and all those policies, went under with the company, but usually those companies get bought out by a bigger company.
Right.
So your policy is saved, right? But who wants to go through that headache?
Yeah.
So the financial strength of a company really plays a significant role in, just giving you confidence that I know they're going to be around when I die, giving you confidence that when I pass away, I know they're going to pay out because they have the money to pay out, right? That's very, very important. So when you're doing your research and when you're talking to, an advisor or an insurance agent or whatever, and this is the thing too. Some people, you don't know to ask these questions.
Right.
Right. That's the thing. That's another thing too. You could be talking to a financial advisor, but if they don't know, they don't know. They can't educate you on it.
Right.
So, I guess that's the downside to it. You don't know what you don't know. But financial strength plays a very critical role. So you want that company that definitely is going to be around for a long time due to its responsibility to its policyholders and making sure, the balance sheet is strong.
Yeah, and you hit on a point where you talked about when you were describing just the tax benefits of inheritance and things of that nature. I know we had a side conversation about this, and I think this is very important, even for older individuals who may listen to the podcast or for young people with older parents that may be about to experience an inheritance in the next 10 to 20 years. Talk about the new Secure Act with the 401k changes, and that can really affect how someone inheritance is taxed, or if they receive an inheritance at all.
Yeah. So prior to the Secure Act, which took place January 2020, if after a parent passed away and the child received the inheritance, they inherited their IRA, the parent's IRA. That child wasn't forced to take distributions out of the IRA.
Right.
Right. They can leave it alone and let it keep growing. With the Secure Act, now what happens is now when a child inherits their parents' IRA, they are forced to spend it down to zero.
The IRA and the 401k, or
Yep,
yeah.
IRA and 401k. So excuse me, I use those. I'm using it interchangeably. So the IRA or the 401k, it's the same rule,
yeah.
right? For whether you inherit the 401k or if you inherit an IRA from your parent, same rule. So now with the Secure Act, you have to spend down the balance of the IRA or the 401k. You have to spend it down completely in a 10-year window, right? It doesn't matter how you do it, and the dollar increments that you take out, it just has to be zero by the end of 10 years. This is very important for, especially, the baby boomers that are retiring now, and this is highly critical for them to understand, because when we're talking about planning now, if this isn't factored in, if there's no conversation around this, what's going to happen is you pass away, your child inherits $1 million, right, from the IRA. What's going to happen is they're going to get slapped with this tax liability that they weren't ready for.
Right.
Right. They can also get pushed up into a higher tax bracket.
Right.
So if I was only making $100,000 and now I just inherited this IRA and I have to take these forced distributions, if I was in a 22% tax bracket, you can bump me up to the 24%, 32% tax bracket.
39, not yet.
Right? To the highest marginal tax bracket, 37% currently, right? So it can really create a mess, right, for your child, and a true headache. And when we're planning, we're having these conversations with our clients, and we're coming up with strategies and ways to make sure, if that does happen, right, then we have the strategy in place to make sure we're not leaving a mess to our children.
Yeah, man. That's when you told me about that, I was like, wow. The government is not set up for you to win if you don't know what you're doing.
Absolutely. And it brings me back to the point of, I got assets, but if I pass away, it's a tax bill attached to all of them, right? So, Ty, there are a lot of individuals who've been working for 30 years. The only assets they do have are their 401ks or their IRAs, absolutely, because my company told me to use this, and this is all I've been doing. I don't have real estate. I don't have a lot of equity in any other space. So all I have to transfer to them is this 401k, right? How do I mitigate that tax burden on my children? What do I do as an alternative so that they're not hit with this tax bill?
One of the best vehicles to use is life insurance, because again, the tax favorability around life insurance. Life insurance is a tax code, right? 7702. 401k, right? 457, 403b. These are tax codes, right? Section, if you IRS code, section 401 subsection K, right? That's a tax code.
Right.
Life insurance it was able to receive a title, but its tax code is 7702.
Write that down.
Right? So this vehicle has its own tax code. We need to take advantage of it because of its tax favorability and being able to pass on a lump sum of money tax-free, or even, if this lump sum of money goes into a trust and we leave instructions with the trust to kick off distributions over a period of time, those distributions are tax-free to our beneficiaries, right? So, but utilizing life insurance is probably the easiest way to solve that problem with the Secure Act the problem the Secure Act has created.
Man, that's deep. We learning a lot, man. Let's talk about some single stocks and investing. I know you deal with a lot of retirees or young adults who are looking to get into stock investing, and it's very sexy to talk about, hey, the Tesla stock split or Apple or investing in Shopify. But my philosophy on it is a lot of people shouldn't even be in single stocks because they don't have the mental capacity to, when the market changed, to not sell at a loss, because a lot of people don't understand you make money in the stock market and you lose money when you buy or sell. Like, the in-betweens don't really matter if you are not doing any activity. So Wall Street makes its money on activity and you make your money on inactivity. So if you buy Tesla right now, even at its high stock price, if you hold it for 5-10 years, it's a high probability that you're going to get a decent return over those 5 years. But when it drops 20%, because Elon Musk has a cough, right? Elon Musk is out, anything can happen to anybody, and it drops 20%, then they sell because they're nervous and, they don't understand stocks, they don't understand the market. So talk about why most people should probably be in a mutual fund, S&P 500. They should look into those vehicles instead of trying to pick single stocks. Like, if that's kind of the hot thing today, option trading, single stocks, and all of that. Talk about the differences.
So, you touched on a few things. I want to talk about investor behavior, right? Because that's something that we have to have that conversation with our clients. And I think this is one of the most critical roles a financial advisor plays in their clients' lives is coaching them around their investor behavior. Rational thinking is we buy low and sell high. That's rational thinking.
Right.
However, for some reason, when it comes to the retail investor, right, their thinking shifts to be irrational, where they're buying high and selling low. Right. So the role that I play is to make sure we're not doing that.
Right.
Right. So when it comes to individual stocks, what makes it difficult to truly build a portfolio of individual stocks is, one, you now have to create the diversification in that portfolio.
Right.
And if you don't even understand, asset classes, if you don't understand the different sectors of, when we're talking about the stock market, the different industries, if you don't even understand that, it can be difficult to build an optimal portfolio made of individual stocks. And if you're constantly fearful, right, when you, like you said, you see that 20% drop and you sell, that's just, why are you doing that?
Right.
Right? Are you doing that to, carry over losses so you can get your tax liability down?
Right.
If you're doing this in a brokerage account, right? Why are you doing that? So it needs to be a strategy if you're going to sell when the market is going down. But for the average person, the retail investor, the individual stocks it becomes difficult to create diversification. And if you don't even understand that, then you're unlikely going to create that portfolio that's diversified.
Right.
So the mutual fund comes into play because the mutual fund gives you instant access to diversification. Even if it's an all large cap portfolio, it's diversified, right? Because that is going to be made up of different sectors. Right, for just for example.
Real quick, you're getting too technical, right? Back it down a tad bit, Ty. What's a mutual fund, right? What's the portfolio? Give us the baseline level, fundamental of, okay, a stock, but he said, I get what a stock is, right? Individual, all these companies I buy up. But what's a mutual fund, right? What's the difference between those two?
Okay, so a mutual fund, simply put, is a pool of assets. What that means is there's a group of people. Let's take us three. Like, we're the pool and we're putting our money into it. Right. So we're pulling our assets together, right? And this portfolio that has all these different stocks in it at different prices, because we have now created this pool of investors that all has their money together. It drives the cost of that portfolio down, right? Because now we're all sharing and we're bearing the cost of what this portfolio would cost if it were just individual stocks that we purchase. So let's say if there's a stock that costs $3,000 and another stock that costs $1,000 and another one that costs $500, the share price of this mutual fund isn't going to be $3,000 per share,
Right.
right? But if I try to get that individual stock that's $3,000, it's going to cost me $3,000. But because now we have this portfolio that's created, and we have all these different investors putting their dollars into this portfolio, it suppresses that cost, and now the share price for this portfolio can be $100 a share, for example, even though there's a $3,000 per share stock in the portfolio. So the mutual fund is a pool, P-O-O-L. I don't want y'all think I'm saying P-U-L-L, but P-O-O-L, a pool of assets, right, that investors are investing in, and that just helps suppress that cost of the portfolio.
And if you're not a sophisticated investor, you still can get a piece of American business by investing in a mutual fund.
Exactly.
And, when the economy does well, you do well.
Exactly.
Because you're invested and you're diversified compared to trying to pick single stocks on Robinhood and you don't know what you're doing and you're just investing because everyone else is investing, right? So Apple goes up 15%. And like you said, most people buy high, and then if it drops 15%, now they're thinking, oh, maybe I should sell it.
Right.
Yeah, so I think for the average Joe, right, I always say that, for the average Joe, you should look and you should talk to a financial advisor. We always talking about how people try to do their retirement on, like, Robinhood. Like, you know what I mean? Like
that I was talking to a friend the other day. He had texted me. He was asking me he said something about Robinhood. And I didn't know. He told me he tried to dump a nice amount of money into his Robinhood account, and they wouldn't let him. They said it was too much.
Right.
And he told me, and I was like, wow. First off, I didn't know that. I didn't know there were caps as far as how much you can deposit. But then it made sense to me. I'm like, you know what? That's why I've never seen a significant Robinhood account as far as its value.
Yeah, this is for amateur retail investors.
I've never seen a seven-figure Robinhood account, but now it makes sense because it's capped on how much you can even deposit into the thing, right? So I always say everyone should, try to have a conversation with a financial advisor just to try to get some education. Get some clarity. Use Google, use Google as well. But get educated first and foremost. That's the most important thing you can do.
Yeah, I mean, I remember we had the conversation about, when we were early investors, we just started using like Acorn or, one of those vehicles just to get used to seeing a portfolio and to, just to get used to being invested in something. We didn't really care what the portfolio did, but just to give us confidence to even be in the market and get a piece of American business. But once we start getting sophisticated, we can't put, all our money on Robinhood and expect us to build a retirement off of that. Absolutely. It just doesn't make sense.
It's funny because I always draw the analogy of being like a financial professional to being a doctor, right? Let's say you had a mobile app on your phone that was about the health of your body.
Right.
Would you just be on the app playing around, not knowing what you're doing? Oh, let me do this medication. Let me just move this around and just play with this and try to figure it out on the fly as I go. Like, would you gamble with the health of your body on a mobile app? Absolutely not.
Right.
Don't gamble with your financial future, your livelihood, your family's livelihood on a mobile app on your phone without consulting a professional with it, right? Like, this isn't a game. If you want to get familiar with a little bit of fluctuation and exposure to the market, that's cool at first for play money, right? But when we're talking about, we're looking at significant long-term gains and we really want to have money to fall back on or to access for business opportunities, in the long haul, we need to be consulting with a professional because I can't rely on playing around with stuff on my phone when I don't know what I'm doing to get me there. And on top of that, like you said, it's capped. There's a limit to it anyway. So there's only so far you can even get with that.
Yeah. Yeah, man. Just imagine something is going on, in your body, or you having some type of ache and you pull up like WebMD or one of those bruh, it's
Try
gonna
to
it's
self-diagnose
gonna you
yourself.
try to self-diagnose yourself, and it's gonna run you crazy because
Yeah.
you don't understand the terminology.
We've all done that.
You don't.
Oh man, I got this.
Right.
What I got? You ain't got nothing, but you don't know what you're talking about,
Yeah,
right?
all
You go
of-
see a professional.
They ask you, do you got a slight cough? You say, yeah, and you got everything. You know,
Right.
you got everything under the book. So I want to wrap this up and talk about just your your philosophy on the fundamentals of a company, looking at the PE ratio, looking at the revenues and all of that as a
Yeah.
sophisticated investor and someone who's behind the scene who understands that terminology compared to just investing in what you understand, what you use, and some things that you actually get value out of in life. So what's your philosophy on that?
Yeah. So, when it comes to, and this is going back to, I guess, stock picking now. When you're looking at individual stocks, and a lot of people always ask, like, how do I even know where to start, what to buy?
Right.
And, once upon a time, I had the time to actually look at a company's financials, where I'm going through their balance sheet. I'm studying, I'm looking at the CEO, I'm looking at what they're planning to do, I'm looking at the numbers. Sometimes I would get really deep and run an analysis to derive what the intrinsic value of the stock is, to see is it overvalued or undervalued, right? And should I get in? I don't have the time to do that now, right? So I don't do that now.
Right.
So what I do, and my philosophy is, companies that you understand, that's a start. Companies that you like and you support, you already spending money with this company, that's a start as well. And that's pretty much the route that I take now. But I'm still looking at, I'll glance at the financials too, just to see, like, does it make sense? Because sometimes, and there are companies out there, it just doesn't make sense that it's priced where it's priced.
Right.
Right. But, the average person isn't going to understand that. So instead of you just creating confusion for yourself, companies that you know and you support and that you feel are going to be around for a long time, just pull the trigger on.
Yeah.
That's what I would say as far as someone that's just trying to, buy some stocks. Now, on the technical side, I've rarely did this, but this is when you're looking at, the charts, right? You're looking at support and resistance, and you're, looking at patterns, right? And you're making your decision, your buying decision, or even your selling decision based off of that. I don't really do that, but that's another route that people can take as well. And sometimes that may be, I'm not going to say that. I was going to say something, but I'm not going to say that. But, yeah, that's another route. But, for just the average person, I would just say, companies that you understand first and foremost. If you don't understand it, then just stay away from it.
Yeah, I think that's very important with a company you understand, because you can invest in something just because it's the hot stock of the day, but you really don't understand how they make money. So for an example, Shopify. I have Shopify in my portfolio. I understand how they earn money. I try to get a little more sophisticated with investing, so I listen to earnings calls and things like that. I'm in that part of my,
as you should, and everyone should. Like the retail investors out there, you should listen to those calls,
right?
Because that gives you more insight on the leadership of the company.
Yeah.
Right now, you're getting that insight. What are they thinking? What are they planning? Why didn't the company perform and hit its forecast goals? Right now, you start to get that insight, and now you start to develop that savviness as an investor as well. So. You absolutely should do that.
Yeah, so one thing with Shopify is because they do free trials, and sometimes they do 30-day or 90-day free trials, that means their next quarter is going to be great because all those free trials are going to convert.
Yeah.
And because once it's a very sticky product. Once you get your small business running on there and you see how easy the tools are and you're converting your leads over to customers, it's very hard to switch that and go to a competitor because you're already seeing success with it. So one of the things the CEO was talking about is, we did beat our earnings and we beat everything that we forecasted, but we could have blew it out of the water this quarter, but we offered a lot of free trials. We extended free trials to people who just were they couldn't pay it because of COVID or whatever, and their business shut down. So we offered a lot of free trials. Obviously, those are going to convert, and once those convert over, then we're going to blow our next earnings out. So that may have turned some investors off, but that incited me to buy more stock. And now, when they report earnings, I'm going to see a return on the investment just off of that decision but I understand how they make money. If I didn't understand that they offer 30 and 90-day trials, that would have been very hard for me to make that decision, because I'm like, why didn't y'all blow the earnings out of the water? Everybody's trying to build an online brand. You are the number one e-commerce brand to go on. Why didn't y'all blow it out the water? But just having that small sophistication, that's not really deep.
Yeah.
But just listening to that earning call
Just
made
picking
me
up the phone.
Exactly.
Right? And listening. That's all it takes. Pick up the phone and listen. Right? And you get that insight. And now you can make a better informed decision. Right? So you got that information, and your mind said, buy more.
Yeah.
Someone else probably could have got that same information and thought, sell.
Yeah.
Right? But that's the beauty of finance is it's art. You know, there's a million different ways to do this. There's no right way, wrong way, whatever. It's art, and you can go about it so many different ways. It's such a beautiful thing. That's why I love it.
All right, you guys. Ty Thorpe, that was beautiful, man. That was beautiful. I really appreciate you coming on, sharing your knowledge. I took some good notes over here, so I'm gonna do some research. I didn't even know about the codes and all of that, so I definitely have to do my research on that. It makes a lot of sense now that you said it.
Yeah.
But I really appreciate you spending your time here, and give people a call to action. You got any social media people? I know they're probably gonna be asking you investing questions now, so give people a call to action.
Yeah. IG is Ty Capital. That's TYCAPITAL. You can reach out to me there. That's the only one I'm going to throw out there. I'm not going to give you the LinkedIn and Facebook and all that. But IG, Ty Capital, you can reach out to me there. But thank y'all for having me. I appreciate both of you brothers. I love what y'all doing.
Yes, sir.